Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. The recent action continues, more or less, to be captured within the two explosive days ranges back in late February, between 1579 and 1759. Since then, despite an initial but now defunct bull channel, the market edged lower in a 2 steps up and 3 steps down action, such at the start of April we saw a test and breach of the support band 1579 to 1571, and prices briefly test down to the 1560 area. Now, this 2 steps up and 3 steps down action had left the door open for a late February, early April action to be a descending triangle pattern. I put forward this as an idea many weeks ago, and in that time I have been patient with the market, but today, well, I've decided to retire this idea as it just isn't working. This also applies to all the relevant targets X through to X0 to X3 inclusive. However, for the moment, I will still maintain the longer term patterns I'd seen over the middle and end of last year and going into this year. They are all bullish, and they are a rounded bottom, a large cup with handle pattern, and a scallop pattern. To be honest, it's been a bit disappointing to see no real attempt at trying for any of these longer term pattern targets topside. But on these there is still time. You see, the rounded bottom still has a primary target topside in the 1983 area, which is off the top of my daily chart right now. The next one is the large cup with handle, which has a primary target in the 1910 area. Once again, this is off the top of my daily chart. Finally, the scallop pattern, or to be accurate, the ascending scallop pattern. This has a primary target in the 1836 area. Until recently, off the top of my daily chart, and interestingly, the one I had the least confidence in, even if it is in the nearest. You can see it labeled X with a question mark. They are all, as I've stressed repeatedly, way out there. But, as we've seen aplenty in recent times, lots of things that are way out there can suddenly happen. Going back to nearer term action, what we have seen over the last 5 weeks or so has not been a move higher, nor have we seen prices turning back down sharply. What we have instead seen is a slightly lower, but basically sideways action. Thus, this action retired all the descending triangle patterns, and we may instead be forming something else completely. This may be in the form of a long time in construction bearish pattern, or it may be in the form of a rectangle pattern. At this moment, I'm not sure which, if either is undergoing construction right now. Now, I would like to finish off once again on something I originally said in my annual review of soybeans made at the very start of 2022. Back then, I was only looking at long-term charts, and I quote, "One other idea I would like to, let's say, provisionally float by you, it's way early on this, but it should be worth considering, is to look at the whole of the 2020 to date actions of possible bullish halfway hesitation. In which case we might have, I say might, with due deference here, we might have a possible target X topside in the 20 and a quarter area. I'll just repeat that, in the 20 and a quarter area. This is way up off the top of my long-term chart, and it might sound ridiculous now. Indeed, it does sound ridiculous, but it is what I see. I'd rather say it and maybe look ludicrous and even laughable now than be silent and be confirmed as an idiot who should have said something should it come about. Anyway, this is a multi-month and likely a multi-year potential target X, so there ought to be plenty of time. Plus, it all depends on what the market does when and if it meets the 2021 high at 1667 and the 2012 high at 1798. This specific bigger picture idea done at the start of 2022 is still there despite the recent daily actions. Chicago soybean meal. Okay, so I've spoken at length about the topping action seen over late January to late April that turned out to be a head and shoulders top with a split head. It's not a perfect pattern, but it was a workmanlike head and shoulders top. 6 weeks ago, the market breached and closed below the neckline, currently 448.60, and triggered the pattern which subsequently fulfilled all the opportunities, primary and secondary, on the downside. Now, a significant part of the erosion of the move lower was the market's reluctance to test the slowly rising long moving average below, currently at 396.40, as well as the 50% Fibonacci line of the 2021 to March 22 move at 389.10, despite breaking an earlier 50% Fibonacci line at 400.5. Prices recovered back from this move, up to just short of the early April 21 high, plus congestion and highs from January and February 2021, all at 433.5. Then last Monday, the market completed a major and rare pattern, all in one day. Last Monday was the weekly key reversal down we saw last week, all made in one day, with the rest of the week just following on lower. Once again, prices were halted by the same obstacles we saw 4 weeks ago. The 50% Fibonacci line of the October 21 to March 22 move at 400.5, I managed to say it properly this time, and the slowly rising long moving average, currently 396.40. And we've seen prices rise this week with a key reversal up and possible day 3 in a 3-day bullish morning star pattern this past Tuesday. Thus, there are 2 possible future market actions that may be in the offing. One is an immediate market pattern, and second is a longer term pattern. The immediate market pattern is to be possibly regarded the market channeling in between the long moving average below, currently 396.5, and the congestion at 433.5 above. The second possible longer term pattern, should it come about, may be strategically massive. It is to regard the whole action since mid-December 21 to date as a huge head and shoulders pattern. This head and shoulders pattern has the original February to April action as a head and shoulders top, as a crown on a larger head pattern. Now, before you start jumping to conclusions, yes, it's a head and shoulders pattern. Yes, head and shoulders patterns, as we've seen here recently, are usually regarded as topping patterns. But, and it is an important but they can also be a possible continuation pattern higher. And just because the last head and shoulders pattern here was a topping action does not mean that this larger one will be, or in other words, post hoc ergo propter hoc. And I think it is really important to stress that point. Therefore, I will be paying special attention to the current rises and watching to see if the May to day action will become a double bottom or a bearish halfway hesitation. Chicago soybean oil. The June 2008 high at 68.97, a relic from those days back then, stopped the fall at the start of April, following the move lower after the changeover gap. Then by mid-April, the market punched up through the 2008 based overhead resistance at 72.67 and made a new all-time high at the end of April. However, the peak on the last days of April was made with a bearish pattern, a bearish engulfing pattern, if only just. And we subsequently saw prices fall down, even gapping lower, down to just after mid-May when they stabilized. What caused the stabilization? Well, it was a combination. It was the 50% Fibonacci line of the February to April move at 75.24, and perhaps more importantly, the rising short medium moving average, currently 77.66. Why was this important? Well, just look at the last time the market tested the short medium moving average, back at the very start of April, and you can see how important it was then in turning the market back up. Hence, treat the short medium moving average with great care in any future dealings. What was additionally special about this turnaround back up was that last week we had a weekly key reversal up here, the exact opposite of what we had seen in the same week in soybean meal. You may read a lot into that, I think. I'll now step back a bit and remind you of one thing, something I pointed out the last few times back in recent days. Back in April, we had a monthly key reversal up. This is part of a longer term pattern, but it is still very, very noteworthy. So I've had both a monthly and now subsequently a weekly key reversal up. This is saying a lot about this market. I think for the moment, that is a little too early. It is a little too early to start drawing bullish pitchforks for the April to June action, but it will be something I'll ponder upon in the meantime. However, right now, the market is reaching up to the very recent 50% Fibonacci line at 81.44. That is the next resistance to be tested in the process of filling in the May gap. Thank you for listening. This weekly broadcast gives you essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyrights Eddie Tofpik and ADM Investor Services International Limited. And here comes the final bit.